Hello, so this is still for the subject capital markets, and the topic is interest rates and their role in finance. This is the fourth video out of 5, and we'll be discussing determinants of interest rates. Okay, so we'll read on. There are various factors in the economy: inflation expectations, the government's monetary policy, the business cycles, government budget deficits, savings, investment demand, money supply growth, demand for cash balances that determine interest rates. Okay, from earlier videos, we've covered and provided examples on how that would affect interest rates. Okay, the supply of or demand for loanable funds trigger changes in interest rates. Okay, if there's too much supply, the interest rates could go down. If the demand is higher than the supply, then the interest rate could go up. Okay, if there's less supply compared to demand, then the interest rate could also go up. Among the major determinants of interest rates are the following: inflation expectations, monetary policy of the government or of the monetary board, business cycle, and then you have your government budget deficits. Okay, we'll go over each one. The level of interest rates strongly tends to rise in periods in which the expected rate of inflation increases. Okay, the rate of inflation would lower the rate of return for investors, and so in times of when there is an expectation that inflation would increase, then they would also like the interest rates to increase so that it would counter the effect of inflation. Okay, interest rates usually fall when expected inflation goes down. So in a way, interest rate would have a direct relationship with inflation. When it goes up, when inflation goes up, interest rates also goes up. If inflation goes down, interest rates also goes down. Okay. The government monetary policy, like measures to encourage loan granting by banks and other financial institutions, by decreasing interest rates, is designed to encourage borrowing. So if the interest rate goes down, there would be more borrowers. Okay, so businesses might be encouraged to borrow money from financial institutions or from the capital market. Okay, but if the interest rates go up, then they might not be enticed to borrow funding. Similarly, to restrain economic activity, interest rates are increased to discourage borrowings, which would have caused an increase in production. Okay, so in times of inflation, normally there is a lot of economic activity that could lead to inflation, right? And so what the government wants, because they're trying to prevent a high rate of inflation, they would want the economy to slow down a bit. And they could do that by increasing the interest rate, because by increasing the interest rates, businesses would have no additional source of funds. They could not borrow from they could borrow from the capital market, but majority of them would not be encouraged to do so because of the high rates of interest. And so with that, by removing that another source of funding for them, then they might be forced to slow down their activities. They might not be able to produce as much as they could because of the limited financial resources that they have. And by slowing down on their production, on their economic transactions, then that would also help slow down the inflation rate. Okay, so that's part of the monetary policy. Where are we? As such, interest rates follow the business cycle. So theoretically, a nation's budget deficit should raise interest rates with an increase in borrowing by the government to fund the deficit. Okay, larger budget deficits are expected to raise inflation expectations, pulling interest rates up via the Fisher effect. However, with the increased globalization, local budget deficits tend to be small in relation to the total worldwide pool of financial capital, thereby decreasing budget deficits, effect on interest rates. Hence, the supply curve for loanable funds tend to be quite elastic with respect to the interest rate. So again, this is in relation to government borrowings. Okay, when the government has deficit, so they would borrow money as well. But by borrowing more, they contribute to the increased demand. So their expectation is that there would be increased interest rates. Moreover, the public tends to be forward-looking nowadays, that they protect themselves from expected future belt tightening by stepping up their current savings rate. Therefore, the supply of loanable funds shifts rightward, tending to neutralize the effect on interest rates of the increased demand for funds by the government. This position is known as Recursion equivalence proposition, denoting rational behavior. That is, perceptive individuals will increase their savings rates when the government is in deficit, while professional financial market participants believe that larger deficits or expected future deficits raise interest rates. Academic economists are still divided on the issue, because they're the government, regardless of, no matter how much they borrow. They're essentially, risk-free borrowers because they're funded by the government, by the public's taxes, right? So this issue is expected to be resolved by more empirical investigation. Okay, but currently it's still not definite. Measurement of interest rate. So we have simple interest rate. In the discussion of financial intermediaries, there is the saver, the intermediary, and then the user of the money. The people with excess funds, the saver, and then the intermediary or the financial institutions, which is part of the capital market. And then you have the user of money or the borrower, normally businesses who would like to fund their economic activities or their production. From the point of view of the saver, interest rate is the percentage of interest income received over the money lent for a period of time. And from the point of view of the user or the borrower, the interest rate is the percentage of interest expense paid over the money borrowed for a period of time. This is a measurement of simple interest rate. The intermediary facilitates the lending and borrowing of money for a spread, which is the difference between the interest rate paid by the user of money and the interest received by the saver. So again, normally savers or depositors, they would only earn 0.25% up to 2% of the money that they saved in the bank. But the borrowers would normally pay, let's say, 8 to 12% of the amount borrowed. So the difference would be the spread by the bank, essentially their own revenue, okay, from facilitating the exchange, okay. From the point of view of the saver, so for example, Mr. A placed his 1 million in a special deposit account with Bank X for 1 year. At the end of the year, he received 1,100,000 pesos. The interest rate from the transaction is 10%, computed as follows. So, difference, 1.1 million minus 1 million is 100,000 divided by the principal, the amount he deposited, 1 million. So 10% is the interest rate, okay? Simple interest rate. From the point of view of the user, okay, the person who borrowed money. So Mr. B needed 1 million for additional funding of his business. Bank X lent him the required fund for 1 year. And then after 1 year, Mr. B paid Bank X the amount of 1,200,000, 1.2 million. So the interest rate from the transaction is 20%. So 200 over 1 million. 200,000 over 1 million, 20%. So from the given transactions, Bank X earned a spread of 10%, which is computed as 20% paid by the borrower minus the 10% given to the lender or the provider of the fund. Okay, so the spread is 10%. All right. Moving on. Next, we have the compound interest rate. So this one would involve time value of money, I think. But not really, but it's just, the earnings of the deposit would also earn interest over time, okay, over a longer period of time, okay. Compounding involves giving interest to interest earned, okay. That is, the interest earned in the first period is added to the principal. The result becomes the principal for the second period, thereby earning a higher interest in the second period. So example, if a bond pays 6% on an annual basis and compounds semi-annually, then an investor who invests 1,000 in this bond will receive 30 pesos of interest after the first 6 months. So 6% on an annual basis. So 1,000 times 3% for the first 6 months. So 30 pesos. So after the 6 months, ang magiging principal na niya is 1,030. And then itong 1,030 na to ang magiging basis of the computation for the next 6 months interest. So 1,030 times 3%. So the investor receive a total of 60.90 for the year. Okay? Yung next 6 months niya, instead of 30 pesos lang, naging 30.90 pesos. Kasi yung 30% na interest niya, na napasama na siya dun sa principal before mag-start yung next 6 months. Okay? So, yung total na naging interest niya for the year is 60.90 instead of straight na 60 pesos lang. Okay? So, the following period, ang magiging principal na niya is 1,060.90. Okay? Tapos, multiply mo siya by 3% ulit. So, yun yung magiging, kasunod niya na interest income. Okay, so the nominal rate was 6%, the compound rate was 6.09%. Computation mo nito, edi yung total interest earned niya for the year, 60.9 through compounding, and then the principal or the deposit of 1,000. So the difference between the nominal and effective rates mathematically increases with the number of compounding periods within a specific period. Okay? Kapag, hindi naman direct, ano tawag doon? Simple interest lang na straight, na for example, yun nga, 1,000 times 6%, mas mababa, compared mo dun sa kino-compound yung interest na earned ng deposit mo. Okay? So, mas preferable, syempre, yung compounding interest rate. Kapag ikaw ay depositor or investor. Okay? Third, we have effective interest rate, or EIR. Measured based on the kind of credit and its term, particularly on short-term credit, which includes trade credit. It is a spontaneous credit from regular purchase of goods. Some suppliers provide credit terms and cash discounts for early payments such as 2, 10, and 30. Credit terms ito sa accounting. Ang ibig sabihin nito, kapag binayaran within 10 days, makaka-receive yung customer ng 2% discount. Okay? Pero kung hindi naman siya mabayaran, pwede siyang bayaran within 30 days. Okay? So the discount rate is 2%, which means that the 2% of the invoice price is deducted once paid within the discount period. Ito yung discount period, yung 10 days. The effective cost of foregoing the discount is computed as follows. So effective interest rate, you have the discount divided by 1 minus the discount rate times 1 over the net time over 360. Okay? So, example, ito, 2 over 98. Okay? 2% over 98% ito, times 1 over 20 days, yung remainder, kasi 10 days yung discount period, tapos 30 days yung total credit period. So, yung difference is 20 days. Divided by 360, which is an estimate lang ng total year. Kasi 30 days per month ang computation. So, yan. Ang EIR niya is 0.0204 times 1 over 0.0556. Or, skip na natin dito sa final answer. 36.72%. Okay? So, yan. For trade discount pa lang yan, ha? Okay, and then next we have bank loans in the form of line of credit, are lending arrangement between a bank and a borrower, in which the bank provides the borrower a maximum amount of funds during a specified period of time. Normally, the bank requires the borrower to maintain a minimum cash balance in the bank called compensating balance or maintaining balance throughout the term of the loan. It could also be a discounted loan in which the interest is paid in advance. Ibig sabihin lang naman discounted, di ba kunwari, nangutang ka ng 1,000,000, pero hindi mo matatanggap yung 1,000,000 ng buo. Let's say, ang ibibigay na lang sa'yo ay 750,000 kasi binawas na nila yung interest payment mo dapat during, let's say, 5 years, na 5-year period. Okay? So, yun, discounted loan yun. Okay, example. Ang kagandahan lang naman ng discounted loan, hindi mo na problemahin yung interest payment. Repayment na lang ng principal ang isipin mo. Example, ABC Corporation has a line of credit with Bank X for 10 million for the year 2016. For any amount borrowed, the bank requires the borrower a maintaining balance of 5%. Assuming the company needed 2 million cash on June 30 and availed the credit line for 12% interest payable on December 31, 2016, Assuming further that the company has no existing deposit with the bank, what is the effective interest rate from this transaction? So, although nangutang ka kasi ng 10 million, meron kasi maintaining balance na 5%. Okay? So, ibig sabihin, hindi mo siya pwedeng gastusin. I-retain mo siya dapat dun sa bank, right? So, first determine the amount the company has to borrow to have a net cash proceed of 2 million. If the compensating balance is 5%, so the 2 million would represent 95% of the amount to be borrowed. Okay, so yung formula niya, amount borrowed equals funds needed divided by 1 minus rate of compensating balance. Okay, so 2 million divided by 0.95. So, ang iutangin niya dapat ay 2,105,263. So, the net proceeds would be the required 2 million. Thus, 2,105,263 times 5% is 105,263, the compensating balance. Net proceeds, ayan, 2 million ang magiging net proceeds niya. Yung kanyang effective interest rate, ito yung magiging computation. Interest divided by cash proceeds times 1 over T. The T is the term, gaano katagal mong utangin yung pera na yan. Okay, so yung amount dito, 2,105,263 times 12% times 6 over 12 kasi 6 months lang niyang utangin, And then yung cash proceeds niya ay dito 2 million, right? Ito. Times 1 over 6 over 12. Okay, kasi again, for the 6 months only. So, ang answer natin is 12.63%. Okay? So, assuming from the example above that the interest is deducted in advance, what is the effective interest rate? Ito naman kapag in advance yung interest payment. So, ang magiging computation niya, so you still have the interest, 126,316. Tapos yung proceeds niya would be 2 million minus the interest rate times 2. Okay? So, mangyayari, 13.48% na ang kanyang effective interest rate. Okay. Let me check this one quick. Okay, it's correct. Next, we have bank loan in the form of transaction loan. So, this is an unsecured short-term bank credit made for a specific purpose. It could be discounted loan with compensating balance requirements, or regular loan in which the interest is paid at the maturity period. So, yung formula in determining the effective interest rate is the same in letter B. Okay? Yung kasunod, we have yield to maturity, YM. The interest rate which equates the present value of all cash flow from the debt instrument with the current value. Hence, the net present value, or NPV, is equal to 0. It is also known as the internal rate of return. There are different ways to measure yield to maturity depending on the type of instrument. So, example, simple loan, ang yield to maturity niya is the simple interest rate. Okay, kasi simple loan lang naman siya. Example, 1-year bond purchased at 10,000 is payable at 11,000. So, yung interest rate at the difference, 1,000 over 10,000, 10%. Okay? For coupon bond in which interest is paid annually and the principal is paid at maturity period, the estimated yield to maturity and interpolation can be used in determining the actual yield to maturity. So, yung formula niya, interest based on nominal rate plus face value of the bond minus the purchase price of the bond. So, after nun, i-divide by the number of years before maturity. Tapos, over the fair value plus the purchase price divided by 2. Okay? So, example niya, 10% 5-year bond of 10,000 was purchased for 9,800. What is the yield to maturity? So, interest is 1,000 kasi 10,000 times 10% plus the face value, 10,000 minus the purchase price, 9,800 divided by 5, 5-year bond. Okay? And then overall, divided by the fair value plus the purchase price. So, 10,000 plus 9,800 divided by 2. Okay? So, yung EYM niya is 10.5%. Okay? Ano nga to? Estimated yield to maturity. Okay? The yield to maturity is between 10 and 11%. To compute for the exact yield to maturity, interpolation is applied. Okay? So, ito, estimate pa lang. Yung actual, you'd have to check kasi hindi pa yan. Okay? At 10%, ito yung kanya magiging present value of interest. Ang computation niya, yung interest at 10%, multiplied by 1 minus 1 plus 10% raised to negative 5, the term of the loan, tapos divided by the interest rate ulit. Okay, so 3,791. Present value of face value. So 10,000 times 1 plus the interest rate raised to the number of years. Okay, so 6,209. Sorry, face value. Present value of the face value. So, yung total niya is 10,000. Sa 11%, so siya naman ay, substitute nyo lang, 11% instead. So, 3,696 plus 5,930, so 9,626. Sa-substitute nyo pa yan, hindi pa rin yan. Interpolation, so you have, at 10%, 10,000 minus 9,800. At 11%, 10,000 minus 9,626, 374. So, 200 divided by 374 is 0.535 plus yung 10% na pinakang base at 10% kasi. So, 10.535%. Okay, so malapit na rin naman to estimated yield to maturity na 10%. Okay, but if you want the actual, so 10.535. Alright, next we have current yield, CY, yearly coupon payment divided by the price of the security. So you have your bonds, tapos yearly nakakatanggap ka ng interest through coupons. So example, bonds with a purchase price of 10,000, yearly coupon payment of 300, will have a current yield of 3%. So 300 over 10,000 lang naman yan. Yield at a discount basis is computed as face value of the discount bond minus the purchase price over the face value, okay, times 360 days estimated for 1 year, divided by days to maturity, okay. Pero itong days to maturity, edi based on 365 years in a year. So, let's say, January, February, March. So, January, 31 days plus February, 28 days. March is 31 days. Again, ayan. So, ayan. Example, a 1-year bond with face value of 10,000 was purchased at 9,800. What is the yield to maturity? So, ito, for 1 year, 1 year. So, ang kanyang discount yield, 10,000 minus 98 divided by 10,000 times 360 over 365. So, 1.97%. Okay? Kasi merong mga bond na 90 days lang, 180 days lang, ganyan. Okay? So, yun na. Doon na nagtatapos itong ika-4 na video for interest rates and their role in finance. Okay? So, if you have questions, maybe in the comment section. Alright, so that's it for this one. Thanks and bye.